Okay, let's get into it. We are doing a deep dive on Jabil Inc. and their first quarter fiscal year 2026 earnings. They reported pre-market on Wednesday, December 17th.
And this one is really fascinating. We're looking at what was, by all accounts, an almost flawless operational call, a huge beat and raise.
Right, but the market reaction seemed completely disconnected from that reality.
That's our mission today. We need to cut through all that noise and just get you the most important facts. Jabil raised their full-year guidance on everything: revenue, margins, EPS.
All driven by that intelligent infrastructure segment, which we'll get into.
Exactly. But despite all that good news, the stock pops almost 5% pre-market, and then it just reverses. It closes down almost 2% on the day.
On huge volume, too. So we have to figure out this puzzle. Why did investors sell off what looks like a great story?
Let's start with the hard numbers, because you can't argue with these.
Okay, lay them on us. The headline number, core earnings per share,
Came in at $2.85. The consensus on the street was around $2.70.
So that's a 5.6% beat, a really healthy beat.
A very healthy beat.
Yeah.
And it wasn't some kind of accounting trick. The revenue absolutely backed it up.
Okay, what was the top line?
Jabil reported $8.305 billion in revenue. That sailed past the estimate of about $8.08 billion.
And the growth rate is what's really telling here.
Yes, that's 18.7% year-over-year growth. For a company of Jabil's scale, I mean, getting close to 19% top-line growth is a massive signal of demand.
And the profitability story held up too, right?
It did. Core operating income hit $454 million, which gives you a core operating margin of 5.5%. They're definitely showing operational leverage.
So the numbers are stellar, the operations look fantastic. Which brings us back to that central question. Why did the market push the stock down?
It really boils down to one thing: expectations and timing.
The stock had a huge run-up leading into the print.
A massive run-up. It was up something like 48% in just the last few months. The market had priced in, not just a beat, but a monumental beat and a guidance raise that was off the charts.
All based on the AI hype.
All based on the AI hype. So when management delivered a great raise, but maybe not the absolute moonshot some investors had modeled, you get this classic sell the news reaction.
So it wasn't a failure by Jabil, it was just investor psychology.
Exactly. The market punished them for not achieving the impossible.
Okay, that makes sense. So let's pivot now and look at where that operational strength actually came from. This is where the AI story really starts to take shape, right?
It is. It's all about the intelligent infrastructure segment, or two as they call it.
That's the growth engine.
It's the undisputed growth engine. It pulled in $3.9 billion in revenue, well ahead of what people were expecting. The upside was all driven by cloud and data center infrastructure, plus networking.
Did they give any specifics on customer programs?
They did. And this shows their execution is really on point. First, they successfully ramped a second major hyperscaler program down in Mexico.
And that's focused on AI hardware.
Specifically on high-density AI storage racks. And second, they called out really strong demand for their next-gen liquid-cooled platforms, which they're supporting out of their facilities in India.
Okay, we've talked about liquid cooling before. For anyone who's not deep in this space, why is that such a huge deal right now?
Well, think about it. These new AI chips, these GPUs, they generate an incredible amount of heat.
Right.
So thermal management, just dealing with that heat, becomes the biggest bottleneck. If you can't cool the chips, you can't run them at full power. Jabil is positioning itself to be the company that solves that massive headache for the cloud giants.
And that specialized work that's higher margin for them.
Much higher. The segment's core operating margin was up 40 basis points year over year to 5.2%. And a basis point is just 0.01%, so that's a real jump in profitability.
But if we only focus on AI, we miss the other half of the story, right? The stability that makes the whole margin picture work.
That's a key point that gets lost in the AI headlines. The stability comes from their regulated industries segment. That segment did $3.1 billion in revenue, and here's the kicker: a core margin of 5.8%.
Whoa, 5.8%. That was up a lot, wasn't it?
It was like 110 basis points year over year, a huge move.
What's driving that?
It's the steady, predictable performance in healthcare. They make essential, long life cycle products. Things like GLP-1 drug delivery pens, for diabetes and weight loss drugs. And also continuous glucose monitors, advanced diagnostics. It's sticky, high-margin business that runs on a totally different cycle than the big AI projects.
So if intelligent infrastructure is the rocket fuel,
Regulated industries is the margin parachute. It provides that reliable, high-margin revenue that cushions everything if the AI cycle ever gets choppy.
it's a great balance, hypergrowth with durable stability.
Exactly. And there's being smart about automotive in that segment, too. They're cautious on the outlook, but they're focused on powertrain agnostic stuff like ADAS and software-defined vehicles.
So they win no matter if it's EV or gas in the long run.
That's the plan.
And what about the last piece, connected living?
CLDC. That was also ahead of expectations, $1.4 billion. It was driven by things like automation, robotics, and advanced retail warehouse programs. So it just shows the breadth of what they do.
Okay, so with all that momentum, it's no surprise they raised the full year guidance for fiscal 26.
And they didn't just nudge it up. They raised total revenue by $1.1 billion, taking the full year expectation to about $32.4 billion.
Wow. And core EPS?
That guidance is now at $11.55. That's a full 55-cent increase from their prior estimate. It shows real confidence in their volumes and their efficiency.
Let's talk about that efficiency then, the margin story. The big goal that everyone's waiting for is that 6% operating margin target. How close are they?
They are marching closer. They lifted the core operating margin outlook for this year to 5.7%. That's a solid 10 basis point bump.
And what's driving that? Better mix and...
Better mix is number one, so more of that profitable too in healthcare work. And number two is just better capacity utilization. They're moving from being, around 75% utilized closer to 80%.
Okay, so they're saying 5.7% for this year. But what about the magic 6% number? Are they just saying they feel good about it, or is there actual evidence to back that up?
That's the skeptical question you have to ask. And they didn't give a hard date for FY27, but the evidence is pretty compelling.
Which is?
The acceleration in their AI business. They now expect AI-related revenue to hit $12.1 billion this year.
Wait, 12.1 billion. What was the previous forecast?
It was based on 25% year-over-year growth. This new number implies 35% growth.
A 10-point acceleration in just a few months.
Yeah. When you see that kind of acceleration in your most strategic business, it suggests the leverage needed for 6% margin is definitely within reach.
And that margin story is tied directly to a strategy shift, right? It's not just building more boxes, it's providing higher value services.
Which brings us to the Hanley Energy acquisition.
The keystone, it seems.
This deal is the keystone of the entire pivot. It's a $725 million deal set to close in January. And you really can't overstate the importance here. Jabil is going from being a world-class manufacturer to a full-stack data center solutions provider.
Okay, so what does full stack actually mean in this context?
It means they're moving way beyond just assembling the hardware. Think about the whole data center lifecycle.
Okay.
Before, Jabil built the compute racks. After Hanley, they're adding critical power and energy management. And it's the most important part. They're getting into high-value services, deployment, installation, maintenance.
So they're not just building the kitchen cabinets anymore. They're designing and installing the entire building's plumbing and electrical systems for the next decade.
That's a perfect analogy. It totally changes their financial model. Manufacturing revenue is transactional. Service revenue is often recurring, and that's exactly what investors want to see.
And this all ties back to earlier acquisitions, right? Like Micros.
Absolutely. They bought Micros for the specialized liquid cooling tech. Now they're integrating that with Hanley's power and service capabilities.
Yeah.
It creates this holistic solution compute, networking, power, and cooling that they believe materially shortens deployment times for their customers.
Which creates a huge competitive advantage.
A huge moat.
Okay, but on the operational side, the big question for a while has been about capacity. Can they actually handle 35% growth in AI demand?
They hit this question head on, and the answer was a clear yes. The factory retrofits they need for liquid cooling are actually ahead of schedule.
And they're bringing new sites online?
New capacity in Mexico, India, they're expanding in Memphis, and then there's the big new North Carolina facility coming up.
That sounds incredibly expensive.
And here's the most impressive part. They're doing all of this without changing their long-term CapEx guidance, which is still 1.5% to 2% of revenue.
How is that even possible?
They're being incredibly efficient, finding surplus capacity in existing sites instead of just building everything new from the ground up. It's a masterclass in operational excellence.
Okay, so execution is there, guidance is up, M&A is locked in. What about the future? What's the upside that isn't even in these new higher numbers?
The pipeline. This is where the real potential for FY27 and beyond lies. Management confirmed they're in active discussions with a potential third and fourth hyperscaler.
And those potential wins are not in the current guidance?
Not at all. They are not built into that $11.55 EPS number. So if they land even one of those, that's a meaningful, unquantified upside lever.
All right, let's switch gears. We're now in our segment where we are absolutely not giving you financial advice, but we are going to pitch an outrageous but plausible trade idea.
So the thesis here is all about a perception gap in the market.
Okay.
The street, we think, is still treating Jabil like a simple, low-margin manufacturer. They haven't caught on to this huge, irreversible shift into a high-value integrated data center solutions provider.
They're missing the margin expansion story that's coming.
They're completely missing it. They see the AI volume, but not the quality of that revenue.
So the trade idea is?
Go long Jabil, and you fund that by shorting one of its peers. A peer whose model is still stuck in that old, low-margin manufacturing world without a real strategy for high-value services or liquid cooling.
And the catalyst isn't this earnings report because that's already passed.
No, the next catalyst is the official close of the Hanley deal in January. After that, you'll start to see proof of the financial accretion and the service revenue mix shift in the next couple of quarters. That's when the market will wake up to the margin story.
Okay, so to wrap this all up, Jabil delivered a stunning Q1 beat.
They raised their full-year revenue and EPS outlook by a lot.
And they showed broad-based strength, all led by that intelligent infrastructure segment, which is now expected to grow at a massive 35% clip this year.
And if you just connect it back to the big picture, in this AI arms race, Jabil isn't just building the boxes anymore. They are transforming themselves to solve the two biggest headaches for their customers: heat and power.
The question is, does this shift from a simple builder to an indispensable data center architect mean their valuation multiple should change too?
That is the strategic question for you, the listener, to think about as you digest these results.
We hope this gave you some quick clarity on a pretty complex earnings print. Thanks for joining us for this deep dive.
We'll catch you on the next one.